Coming up today, China unleashes a stimulus package, all the big knock-on effects across global markets. Jensen Huang's done selling. The Fed's lone dissenter said inflation could come back. Gold hits another all-time high. The Justice Department sues Visa. And is this the start of a new Chinese bull market? It's a big day, guys. Let's go. And welcome back, everybody. Don't the financial markets keep it interesting and entertaining for us all? Still calling up here on the S&P 500. Did find all-time highs. 57.32. Market picture still very bullish. Have American shares taking a bit of a back seat today. All the action is coming out of China. Look at that candle. China 50 index up 8.4%, with the Nasdaq Golden Dragon index up over 9%. This is an index of Chinese stocks listed in New York. The most popular ETF, FXI, up almost 10% on a complete MOAR move, the mother of all rallies. Hong Kong shares ripping up. Chinese internet ETF, KWEB, smashing higher over 10%. Alibaba close to making it back to triple digits. It too up over 7%. On massive volume, starting to make those high 60s look really cheap now. And of course, just about every Chinese stock and ETF did really well today. In fact, my most recent stock pick for members last weekend was a Chinese stock, and it too is already doing good right out the gate, and no doubt I'll be adding more Chinese securities to my portfolio just around the corner. As many of my regular viewers know, ever since Xi Jinping flew to America in November last year, met with business leaders, I turned bullish once again on the Chinese stock market. As it became obvious to me, the Chinese government are really trying to get underneath their markets, and we just got news of that today in a big way. And stick with me today, because after I talk about China and a few other things, I'll let you know what's going on with Visa, why they fell so hard today, and I'll also show you Nancy Pelosi's latest trade on Visa, in which she conveniently sold over $1 million worth of shares. I'm also going to show you all the knock-on effects from China's big stimulus package today across global markets, including copper futures ripping up, helping copper stocks like Freeport, McMoran, and quite a few other material stocks as well. Just like Jay Powell last week, threw a big rock in the lake of financial markets, China just did again the same today. We got global liquidity ripping to the upside, and once again, this has big knock-on effects. Chinese government and the Fed look to have gone all gas, no brakes, and the great global print could be upon us. It's also helped gold to find brand new all-time highs. However, you won't hear much about it from mainstream media. And silver doing even better, now pushing up right against 52-week highs, above $32 an ounce. Those of us positioned in commodities and international stocks had another great day, along with Bitcoin starting to shape up as well on the back of, once again, a heavy US dollar, now sitting just above 100, pushing down against the bottom of this support zone, of which it had been trying to hold. US dollar under a lot of pressure here. So just to get down to the nitty-gritty of it all, China's been trying for almost a year now to get underneath their economy and markets, and we just saw their biggest shot so far, of which they pretty much just pulled short of going all in. They unveiled monetary measures, including cutting key short-term interest rates, reducing bank reserve requirements, and announcing over 800 billion yuan, that's over 110 billion US, liquidity support for stocks, basically allowing funds, brokers, hedge funds to borrow straight from them to buy stocks, in addition to bringing down the cost of capital and the amount of capital banks have to keep in reserve. In other words, trying to stimulate lending, credit growth, and that's how you start an economy back up. Get the banks lending again, more investment, more jobs, more spending, and so this is a pretty clear signal to the market that they're trying to put a bottom in their economy and markets and reverse the deep, dark 3-year bear market they've been in. Data on the ground is pretty bad. However, markets don't trade on what's happening now. They trade on what they think is going to happen next. And we are getting some pretty positive technical signs out there, including this monster momentum thrust. China CSI 300 index sees its best day in 4 years. And this comes at a time when global investors left, right, and center have pretty much given up on Chinese equities. We can see this in Goldman Sachs data of PrimeBook's percentage of total global net exposure to Chinese equities at record lows, below 3%. In fact, looking at the latest Bank of America Global Fund Manager survey, short Chinese equities, second most popular trade after long big tech. So there's a few shorts getting covered there today. And they've signaled a willingness to go further and do more, weighing up plans for a market stabilization fund after they're going to allow institutional investors to tap central bank financing for stock purchases. That's an incredible move. Pretty much just telling hedge funds to buy Chinese shares. You got the backstop of the CCP. And it wasn't just your host that saw this coming. It's also some other big American investors like billionaire David Tepper and his hedge fund. His biggest position, Alibaba. After we saw in the last couple of quarters, he had been trimming his positions in American tech. He's also got Pinduoduo, FXI, the Chinese large cap ETF, which he added to in the most recent quarter. He's also got BIDU, the Chinese internet ETF, which he added to in the most recent quarter. He's also got JD and, interestingly, Taiwan Semi. However, even though we're getting a really good technical bounce here in Chinese shares today, the best we've seen in years. That doesn't mean they're out of the woods yet, nor does that mean every investor is turning bullish on them. Chinese shares have been so hated, so given up on, they have got a huge wall of worry to climb before mainstream comes back in and inevitably buys again. Still plenty of rhetoric and articles and posts across social media. China's stimulus may keep it from spoiling the global economy, but it still isn't enough. With them arguing structural challenges still persist, including weak domestic demand, high local government debt, and international trade tensions. With them saying more measures are needed to address underlying economic issues. They've also got issues with demographics as well, declining population, and the knock-on effects from their one-child policy, which they only gave up on a few years back. We also got this article in Barron's today, a banking crisis is looming in China. It's not just property. And so it's been really property that's brought down the Chinese market. They simply overbuilt way too much. Literally empty cities over there, empty skyscrapers, they're actually starting to tear down now. And that caused a lot of the bond market to take massive losses. Of course, that ripples all the way throughout their financial markets. And so just to be clear, I'm not saying things are great in China right now. Like I always say, technicals lead, fundamentals follow. And even though I never ignore the fundamentals, I always give more weight to the technicals and what smart money is doing. So for sure, even if we have seen a bottom in the Chinese economy and markets, it's not going to be a straight line back to the top. Of course, it's going to be a bumpy road. It's going to be plenty more pullbacks and shakeouts, even deflationary risks if they can't get underneath their markets. According to Zero Hedge, the half-life of this intervention will be 2 to 3 months. Then markets will realize China is not stimulating demand. Then we see new decade lows. Then China goes all in with a $2 trillion plus fiscal bazooka, which, like I said, we may not have seen the last of their stimulus package. They may need to do another one in a couple of months. But one advantage of having an authoritarian government is they don't have to sit there and argue about it for months on end. They can just pull the trigger, and in my opinion, they'll go as big as they have to. They've got plenty of room when it comes to government debt to GDP. They've learnt from the Americans and their ability to print their way out of a crisis. And it looks like the Chinese are learning to do the same thing. How we're still getting plenty of memes posted online today like this, waiting for the Chinese stimulus to actually work. And another one like this, with an angry face representing the majority of the population saying, no, it was just a technical adjustment, with low IQ and high IQ people just saying, China stimmy, number go higher. But like I said, even if this is the start of a new Chinese bull market, it's not going to be a smooth ride back to the top. Even in the best performing stocks of all time, an analysis found, looking at 84 10-baggers, that's stocks that have gone up more than 1,000%. On average, those stocks saw a drawdown of 48%, with a typical downturn lasting 114 days, almost 6 months. And that's why you have to give stocks time and room to make big moves. 5-10% trailing stops simply do not work. And like I said, this has big ripple effects all across financial markets, along with forecasts, expectations, and much more. Obviously, Chinese shares ripping today. Also, the Chinese yuan, their currency popping up. But this has big implications for the commodity markets, especially markets like copper, which, like a lot of commodities, China's responsible for over 50% of the world's demand, as they're still in a long-term secular trend of urbanization. Plus, copper is one of the critical metals of the AI boom. It's used a lot in electrical wiring. It's got really good resistance to corrosion. It's used all across plumbing, roofing, even in renewable energy, wind turbines, solar panels, you name it. Is a really important metal of the future, and that market reacted today, up over 4% today. Got another pop in uranium, and a lot of commodities are starting to shape up, even agricultural, soybeans. Sugar's been on a tear for the last week, even coffee starting to tick higher. Natural gas ticking back up, and of course crude just holding ground there. Not a huge reaction, but nonetheless firming back towards its 50-day. And actually agricultural commodities now sitting close to a 52-week high, and surprise, surprise, once again, the market's expectations of inflation ticking higher as well. Higher highs, higher lows. Shipping stocks having a great day, up over 3%. Semis trading firm, up almost 2%. And there's materials breaking out. Best performing sector I've got here, junior gold miners. And once again, a little bit of softness in the defensive sectors. So this is a really liquidity-driven, risk-on move, and it was really material stocks. Putting in some of the best performances today on really big volume. This is big institutional money coming in on this. And I mean, just look at that candle in the China 50 index. What a true outlier. That is one for the history books. And nothing changes people's minds like price action, so it's no surprise we're getting some bullish articles like this today. Why stocks have a lot more room to rally before hitting a peak, with the analysts pointing towards strong market breadth and resilience across sectors like industrials, financials, and technology, with them saying we continue to balance seasonal headwinds against our view that evidence of a major top is not compelling. Also got the advanced decline line breaking out to all-time highs. Market breadth is there, and the market is trading pretty firm in what's normally a seasonally weak period of September, going into October as well. Not to mention the federal election just around the corner. The market doesn't seem too phased by all of that. One thing that had been weighing on Nvidia of late and the semiconductor sector as a whole was the godfather of AI, Jensen Huang, CEO of Nvidia, had been doing some relentless selling of his own shares, selling almost $750 million worth. However, we're just getting news today that he's reached the 6 million share maximum threshold he's permitted to sell under a pre-arranged plan adopted in March. So he's pretty much just hit the limit of what he can sell, and he had been doing it over the last couple of months, in which it's been consolidating. However, it too had a nice pop here today, up almost 4%, and we got some bullish seasonality coming into it, just looking at my seasonality forecast indicator. Over the last 5 years, on average from this point, Nvidia will rally 13% over the next 20 trading days. That's one calendar month. And even though the S&P 500 is currently up month to date, just looking back in history, no month has less new highs than September, coming in at only 79. In fact, November is usually the most bullish month going into that end-of-year rally. Is this time different? We even got some like Ed Yardeni now saying the stock market rally risks sparking an unsustainable melt-up as the economy overheats. What happens if real estate and stocks continue higher? What do you think wealthy people are going to do if all their portfolios continue to tick up? They're going to keep spending big. And what does big spending do? It drives down the supply of goods and services, which inevitably drives up the price. For those at the top, they don't really feel it at all. It's kind of just an afterthought. However, for the bottom 50% of people, it's life-changing. Or maybe a jump in economic growth could be the stock market's nightmare scenario. Maybe if inflation comes back faster than the jobs market improves, maybe the narrative running through financial markets now will switch back from worrying about the jobs market to once again worrying about inflation. The Fed themselves sees GDP growth at 2.9% this year. They see unemployment rate coming down next year. They also see their Fed funds rate going down to 2.9% by 2026. However, miraculously, they see inflation going back down to 2% as well, in what would be the most perfect economic landing ever orchestrated in the history of markets, if they are to achieve their forecasts. Or maybe that's just a forecast now, along with the threats of more 50 basis point cuts, just to give markets a little sugar high for a few months. Then maybe next year they'll downgrade their forecasts and start talking about inflation again. But for the here and now, they are super bullish, very supportive of the markets, really indicating they want interest rates way lower, while still saying the economy's great, the jobs market's great, inflation, although it's not where they want, it's coming down to where they want. However, we do have one Federal Reserve governor going against the grain and speaking out, likely at Jay Powell's dismay. That's Michelle Bowman, the only lone dissenter in last week's Fed decision to cut interest rates 50 basis points. First dissenter in almost 20 years, she believed they should have only gone a quarter of a point, as she says inflation could still bounce back, which is so obvious it can. She's just the only one from the Fed wanting to talk about it. She said, "I preferred a smaller initial cut in the policy rate while the US economy remains strong and inflation remains a concern despite recent progress." It's kind of amazing to see the Fed do a 50 basis point cut, talking about doing another 50 basis point cut, and we've actually got the PCE inflation data due out this Friday, expected to come in at 2.7% after the latest reading came in at 2.6%. And if you talk to people in the economy, they would argue their rent and food is going up more than 2.6% a year as well. But we've got the most dovish Fed in all of that. And how many people out there can afford another 30 to 40% jump in their goods and services over the next 4 years? If this government keeps creating currency out the wazoo, in which they've managed to take the consumer price index, best measure of inflation, the most elevated above its 50-year linear regression trend line that we've ever seen. Now, because the year-over-year increase from that huge base is only 2.6%, they're kind of claiming victory. However, a few of us are not forgetting the embedded structural inflation from 2020. We are still well above trend when it comes to inflation. However, the Fed looks at all this and thinks, let's get interest rates down to 2%, or at least threaten markets to do that for the here and now. And it's all this stuff that makes me so bullish on commodities. Not to mention wanting to lower my exposure to the US dollar, which you can do when you're long commodities and international stock. We also got the latest read on consumer confidence today, sliding a little bit, dropping to 98 from 105 in August. Once again, getting mixed economic readings up and down, and consumer confidence has been abnormally low the last couple of years, even though property, stock, and jobs market have been at all-time highs. Most people are just not feeling all that optimistic. In fact, there's a long-term chart of United States Consumer Confidence Index. And so that's a monthly survey which focuses on how consumers view prospects for their own financial situation, the general economy, and over the long term. And you can see going into COVID, Americans had never felt better since the early mid-2000s, that last bull market. Then we had the global financial crisis. Of course, the late 90s was a great time. Everyone was optimistic. Wealth inequality wasn't as bad. However, no surprise confidence fell off in COVID. However, it never really bounced back. Like I said, even though we've got property and stock markets at all-time highs, unemployment rate went under 4%. Most Americans just not feeling nowhere near as good as they were prior to the pandemic. And I'd say a large part of that has to do with inflation. Like I said, in this time here, a lot of people's bills, cost of living's gone up 30-40%, while many people haven't seen any increases in their wage, or maybe only 5 to 10% of increases. And a lot of people have had to pick up gig work, night work, second jobs and such, just to keep up. And so once again, we'll get another look at inflation this Friday, which I don't expect any surprises on the upside just yet. Policy decisions now will flow into markets and data over the coming months, maybe a year or two. Plus, just like we've seen from the Bureau of Labor Statistics, these government departments have quite a lot of discretion in the headline prints they feed us. We just saw the Bureau of Labor Statistics come out a month and a half ago and said, oops, we accidentally overstated the jobs growth by 30%. Not 3 or 4%, which would be acceptable, dealing with a lot of data. However, in today's day and age, is 30% really acceptable? And we're just supposed to take them at their word for whatever headline print we get. But when it comes to it, at the end of the day, markets do take them at their word for whatever headline print we get. So we do have to pay attention to it, even if it is fudged a little bit. Like I've been saying recently, maybe we get the real data next year. But for the here and now, bond yields are just still muted. Not much action since Jay Powell's big dovish move. There's the 2-year, still trading heavy, 354. The 10-year, a bit more firm, but still in a persistent downtrend, 373. Once again, high yield bonds still holding up, along with high yield spreads over treasury. There's no stress in credit markets here at all. And the meme of the day goes to this one. Xi Jinping and Putin as opera singers singing another gold all-time high. Once again, I'm hard-pressed to find any articles across mainstream financial media talking about gold, not really talking about the US dollar or Bitcoin much either, but it is definitely marching higher, as the US dollar could be marching towards a crisis. With one investment advisor on X today saying, the odds of gold replacing the US as the preferred reserve currency of half of the world are much higher than the odds of US remaining the sole reserve currency of the world. That is why gold continues higher in all currencies. Either you understand history or you don't. And I mean, he does have a point. Half the world is trying to replace the US dollar with gold as their reserve currency. They don't want the US government to have leverage over them and issue sanctions and freeze up their assets. And this really kicked off after Russia went into Ukraine. It was a big pursuit to get off the US dollar, as a lot of the world saw the US government freeze Russian USD assets around the world. Got another one coming out from a CFA saying commercial silver net short 77,000 contracts, lost 560 million today. Commercial gold net short 335,000 contracts, lost 2.4 billion today. The US dollar's status as the world's reserve currency is ending. We are watching history in real time. And that's a bit of a dramatic call. I wouldn't go as far to say its reserve currency is ending, maybe over the next 10 or so years. It's certainly accelerated this last couple of years. In my opinion, foreign policy has been an absolute disaster. Ever since the botched withdrawal out of Afghanistan set off a chain of events that is still in motion today, and markets don't lie. In the eyes of gold, silver, the US dollar has been getting decimated. And what happens if these Chinese stimulus measures actually work, really ramp up the world's second largest economy and the world's biggest consumer of commodities? At the same time, American interest rates are coming down, along with the worst Middle East tensions we've seen in our lifetimes. What could all that equal? Potentially higher oil, higher cost of goods and services, other commodities going higher, inflation going higher. What's the Fed going to blame it on this time? Last time it was supply chain restrictions from COVID, along with Putin. If only more people knew how inflation really comes about, maybe those that cause it will actually be held to account. In fact, news from oilprice.com says China's crude oil imports surged to 11.56 million barrels in August, the highest monthly volume this year, with a 25.6% increase from Russia. Beijing capitalized on cheaper supplies from Russia, Iran, and Venezuela. And that is one big advantage China has now, being closely aligned with Russia, is they can secure cheap energy as they share a border with them. And the Russians are able to dig it up and distribute it very cheaply. And just like the investment world had given up on China, there's a lot of funds bearish on oil as well. In fact, according to this chart here, hedge funds have built record crude short positions. And looking at this chart here, Bitcoin correlates the most with global liquidity. The amount of liquidity central banks around the world are pumping into the system. And you could kind of think of what China's just done as massive quantitative easing, something the Fed's been doing a lot since 2008. And that's typically good for Bitcoin, which you could kind of think of as a global liquidity proxy. Stocks and gold not too far behind. And so like I said, it looks like Bitcoin is shaping up, ready to take another stab at all-time highs, a bit above $73,000 a coin. And just moving on to one of the biggest headlines today, and pretty interesting after I came out with a bear case yesterday for Visa, in which I also said they share a duopoly with MasterCard that is under threat from competition and retailers like Walmart trying to bypass them, allow their customers to make instant bank payments through improved networks. We just heard the Justice Department today is suing Visa, alleging an illegal monopoly and debit card payments, saying the US largest card network blocked rivals through payments and higher fees levied on merchants, government says. And they've been doing this for pretty much as long as they've been in existence. They're so ripe for disruption, they could potentially be the most disruptable companies in the world, in my opinion, Visa and MasterCard. The lawsuit says Visa used carrots and sticks to keep potential competitors off its turf and to punish merchants that did business with rival. And they are just a big tax on the whole system. Like I said yesterday, in my example, if you buy a good or service with a $50 cash bill and that person that sold you the service does the same thing, that $50 remains $50 everywhere it goes. However, if you pay for it with a Visa or MasterCard credit card, that $50 gets 1 to 3% smaller every time it gets spent. In reality, with today's technology, payment processing fees should be 0.1%, next to nothing. This 2-3% is actually ridiculous. So I agree 100% with what the Department of Justice is trying to do here. And it looks like the market does as well. After it had been on a great run the last couple of weeks, fell really heavy today in what was otherwise a firm tape, down 5.5%, finishing on the lows, which is a big move for the normally low volatile Visa. But like this article says, the case could weigh on shares for a while. Looking back in history, this is not really a bullish thing for a company when its own government comes after it. It also just opens the door for competition, just gives tailwind for others to come and try and knock them off their perch. However, one Visa bull looks to have seen it coming. And again, something we've seen many times over the years, Nancy Pelosi just so happened to sell $1 million worth of Visa 2 months ago. What a coincidence, right? And that's not just speculation. Here's the transaction report filed in the House of Representatives showing Nancy did indeed sell 2,000 shares of Visa back in July. And so it's no wonder her and a garden variety fund manager of a husband are worth over $250 million. When you get privileged information, investing becomes a whole lot easier. But imagine being worth $250 million while watching your city that you've helped to shape over your entire life go down the toilet. That's extreme corrupt capitalism for you. And speaking of corruption, just got Elon Musk retweet a post that says the FCC has fast-tracked George Soros' bid to dominate the airwaves. Last week, the FCC adopted an order to approve his purchase of more than 200 radio stations in 40 markets, just weeks before the presidential election. The stations reached more than 165 million Americans, in which this was unusually fast-tracked. And so this just adds to the criticism that most mainstream media is turning into a one-party state, like most of big tech. All that's really left is Washington, and like Elon Musk says, he's worried about America turning into a one-party state, as it's definitely been moving in that direction. With Elon also hinting that they may shut down X as they seek to enhance censorship laws and what they call misinformation. Certainly interesting times indeed. As we go into this all too important US presidential election, and which is set to have ripple effects for many years all across the world. And so just imagine you're a staff member of one of his 200 radio stations. You're not going to really speak out against his policies, are you? Someone like this shouldn't be allowed to own 200 radio stations in the state. We even got VC billionaire Chamath saying this is disheartening, that the FAA slow rolls SpaceX approvals to launch Starship, while the FCC fast tracks change of control of media partially into foreign hands right before an election. Can't the greatest country in the world do better than that? It's kind of mind-blowing, isn't it? Anyway, that's the way the world is. Hopefully changes for the better. That sort of stuff certainly hasn't worked out for Europe. But just moving on to the economic calendar, there's consumer confidence coming in a lot lower than expected. US house prices still increasing year over year. We'll get another look at housing data tomorrow. Thursday, durable goods, GDP growth rate for Q2, the revised numbers, jobless claims, heaps of Fed speakers, in which I'm sure they're going to be really dovish, except for Michelle Bowman, she's speaking her mind. Good on her for doing that and going against her colleagues. Then Friday, the big one, PCE, in which I'm sure we're going to get the print for the core index 2.7. Really going to upset markets. That comes in hotter. And so I'd be surprised if that's what we get. Should be 2.7, if not 2.6. And this is incredible. Look at this again. Fed fund futures now pricing in greater probability the Fed's going to cut another 50 basis points in early November. Markets pricing in interest rates dropping like a stone. Is the US economy just about to fall off a cliff? Is that what the market and Jay Powell are seeing? He just doesn't want to tell us that. Or is inflation miraculously going to go back down to under 2% and they're willing to gamble on that and keep dropping interest rates as hard as they can? Or are they just indicating to the market here and now they might go another 50 basis points in November, keep things on a sugar high until then maybe their narratives change after November? Let me know what you think in the comments below this video. And just looking across key markets, there's the VIX getting down to a low 15. Option dealers marking down their IVs as well. There's Intel still sitting firm, along with Tesla trading up as well, above $250 a share. But the monster move today was China. FXI up almost 10% on 167 million units traded. What a monster move. The mother of all rallies is the golden dragon back. Let me know your thoughts on that one as well. Thanks very much for sticking with Click Capital, and I'll see all you guys again tomorrow. Cheers.